What's up, guys? Today, I wanted to share 5 strategies that have helped me make more income from yield farming, and hopefully these strategies would help you make more money as well. So if you're new here, my name is Richard. My channel is mainly about yield farming. If you guys look at my current open position here, you can see my open positions are sitting at a nice profit and loss, 6.8 Ethereum of profit. Some of these positions have been in a loss for a long time, like this arrow to ETH, and finally just started swinging back up. This is completely normal if you're yield farming altcoin pairs, but hopefully we close out each of these positions in profit. Some of them are still sitting in a loss, but up overall pretty nicely here. If you add my closed positions, you can see I'm up roughly 8.6 Ethereum. So sitting on roughly 15 ETH of profit right now, while earning a 50% APR on my capital. Recently, I made a new wallet for leverage yield farming. I'm trying to make a US dollar profit here. This is still sitting in a loss. Not a big deal. I'm still generating really nice cash flow from these positions, and hopefully these flip to profit over time. But what I want to show you guys today is 5 really tangible strategies that hopefully help you secure more profits. And before I dive in, none of this is financial advice. Please do your own research before making any investment decisions. So if we look at this risk and reward chart here, typically the higher risk you take, the higher the potential reward. And the reward is never guaranteed, especially in crypto, but over a long enough time horizon, hopefully we have much more reward because we're taking more risk, comparing to just traditional investments, for example. So the first really practical way to basically generate more income is to dial up the risk. I like to do this when the market price is really cheap. I buy solid assets at a cheap price because it's much more likely to generate a higher return. And most of our investment would basically fall onto this line, right? If I take on more risk, hopefully I would get more reward as well, especially if I'm yield farming lower cap altcoins and altcoin season comes around. I would expect much greater rewards than just buying and holding Bitcoin, for example. So that's the first way to basically get more return by dialing up risk. And sometimes you guys would find great investments that have like pretty low risk, like up here. But over time, as other investors basically learn about the investment, they bid up the price and the reward would drop as well. So this is what we're seeing pretty much right now with Bitcoin. It's sitting near its all-time high. Of course, it could still push higher, but to expect another 2 to 3x in the next 6 to 12 months, I think that's a little bit of a stretch, but it could definitely happen, right? Because no one can tell the future, but really everything would be adjusted here. And if people are in bad investment, typically they find out that the return is not worth it. So then they sell off their investment, the prices drop, and then it reaches this equilibrium point once again. So that's how the market works. If you guys look at my positions here, most of these are in smaller cap altcoins like Pixel, Arrow, AIXBT, MOG, basis for everyone. But I'm sitting in nice profits because I'm generating more fees, and I entered some of these at a decent price. For example, this bonk pool, even though there's a slight divergence loss in Ethereum terms, which means that it's trading below my entry, the fees are still enough to cover the loss I'm suffering. So that's the idea here. And you guys don't want to basically use your whole portfolio to yield farm smaller cap altcoins, right? You want to use a portion of it that you're comfortable to lose, because at the end of the day, these tokens are really high risk. If there's a black swan event, some of these tokens could go to absolutely zero, but they could also do really well long-term as well. So that's the first thing we could do. We find high volume pairs that we could add to our portfolio. Even though it's higher risk, it could be worth it over a long period of time. Some of these pools like Toshi and ETH, for example, is pulling like 49% APR right now. Anime and ETH, 144% APR, but suffered quite a lot of impermanent loss right now. Hopefully, I'll be able to beat it in the next 6 to 12 months. But in any case, it would boost my APR and return over time if I take on more risk. But I do need to keep the risk in check by making sure that I'm taking profits on these positions. So that's the second way of actually making a profit, is to make sure that you're taking profits on your positions. So one really simple way that I like to take profits on my position, for example, is to use the fees that I generated to buy more Bitcoin. If you look at this SOL to ETH position that I closed last month, I basically used my SOL and Ethereum from the pool that I generated to buy Bitcoin, right? And similarly with these other pairs here, I use a portion of my fees every single month to buy Bitcoin because Bitcoin is a much safer and secure investment. And that's how I'm able to reduce my risk over time, even while yield farming these higher risk plays. And that's how we could actually stack a lot of our profits. And you guys could dollar cost average into other assets you believe in as well, right? For example, Solana, if you believe in Solana, then you could take profits on some of the lower cap altcoins like Arrow, or if you're yield farming Solana pairs like Bonk to Solana, for example, you could use the Bonk portion to buy more Solana, right? That's something that you could do. Or if you're yield farming Radium and Sol, you could use that Radium portion of the fees to buy Solana. So that's how you take profits on your fees. And another way to take profits is basically exiting your position for a profit. You could see here this ETH and Sol was exited for a profit. And some of these are rebalancing positions. That's why it shows like a loss here. I'm still in this pool, still trying to make a comeback from this. But for most of my closed positions, I tried to close in Ethereum profit if I'm yield farming Ethereum pairs. You can see here Pepe and ETH, Pendle and ETH recently closed in profit, Kaito and ETH as well. So always think about securing some profits. That's going to help you retain profits, especially when the market pulls back. Then we could decide to redeploy our capital. And the third way is to basically compound your fees into existing positions. For example, this Bonk and ETH pool here, I'm fine with a heavier allocation. So then I compounded both the Bonk and Ethereum into the same pool. And over time, I would accumulate more and more Bonk and Ethereum in the pool. And as these two tokens appreciate in price in the bull run, then my earnings would grow as well as my original liquidity. So for Bonk and ETH, it's trading slightly below my entry at this strong zone of support here if we price it in Ethereum. I entered roughly here in this zone of support at around 0.00064. It's slightly below, so not a big deal. If I'm still bullish on this project, I actually want to compound more when it's below my entry because what it does is it actually drags down my entry, right? For example, if I entered all the way up here, it's not a big deal if I want to grow my earnings and I still believe in this project. I'm just going to compound my fees. And over time, my entry would be lower and lower and lower. And then when the token rips back up, I would be sitting in Ethereum profit in terms of my original liquidity. And this doesn't include like the fees that I earn, right? If it's above my entry, I would be in Ethereum profit if I'm pairing Bonk to Ethereum here. So that's the strategy that I could use. So the fourth way is instead of compounding your fees into the same pool, you could accumulate these fees here. Let's say I'm stacking some Ethereum here, right? And I want to yield farm a new Ethereum pair. For example, Pendle to Ethereum if I'm bullish on Pendle. I am bullish on Pendle. I close my position for a profit. Hopefully it retraces a little bit so I get a nice price. If I want to enter into a new Pendle pool, I could do that. And this is especially good if you guys don't want to add to your existing positions because you already have a good amount of allocation to all of these pools. Then of course, we could always invest into a new pool and that new pool would basically generate more yield as well. So that's the fourth way, and it's really going to help you guys grow your portfolio really quickly here, especially if you guys are working less than 6 figures. You're compounding a lot of your DeFi income into either same pools or new pools, and over time, this DeFi portfolio would grow by a lot, especially if you guys are putting other sources of income from either trading, airdrop farming, or if you guys have a job, then you could put that income into your DeFi portfolio as well. That's one of the fastest way to actually grow your DeFi portfolio. So if you add like, let's say $1,000 a month into your DeFi portfolio, assuming you made like 0 returns and there's 0 capital appreciation, that's still like 12K at the end of the first year, right? And let's say you do that for 5 years and without any capital appreciation, you would have 60K in DeFi that's earning an income. And with $60,000, just generating a low 25% APR, that's an additional $15,000 per year of income, right? So that is pretty significant for most people. And let's say you have 60K, you grow that portfolio by 25% per year. We multiply that by 1.25. So you would have 75K. We do that again, 1.25, 93K, right? Multiply that by 1.25. Now you're over six figures. So that's how you could basically compound your growth and grow your portfolio really quickly. And the last way that I want to give you guys is you want to try to find the highest APR pool for the assets that you're providing liquidity for. Sometimes we could be yield farming the same exact assets, but one person might be generating more return because they're in the better pool, right? The pool that generates most amount of APR. There's multiple ways to do this, but for this video, I will show you guys one way. We could use revert finance, and this is really good if you guys already know which token you want to provide liquidity for. We want to go to this filter tab here, and for this example, I'm going to use Ethereum, and let's say USDC. And the position age, I don't want it to be too new because sometimes the APR is not accurate. So I could put like, let's say 150 days here, and then no withdrawals, and then in range only to make the APR the most accurate. And then I could hit apply. So keep in mind that revert finance only supports these networks and these exchanges, but we're going to be able to find a lot of these blue chip pools pretty easily. So right off the bat, I could see like different pools on Aerodrome, Uniswap, on different chains like Arbitrum, Base, and ETH mainnet. I prefer to provide liquidity in Uniswap because usually I get a higher APR with a wide range strategy because people like to squeeze their range a lot on Aerodrome with either like automated tools or manually. So I don't use a lot of Aerodrome even though I'm bullish on the project. But let me show you guys what I could do here to find the best pools. Because right off the bat, there's like so many different pools, right? What I could do is click onto each of these pools. So the one on Arbitrum here and open it in a new tab. On ETH mainnet, I'm going to focus mainly on Uniswap pools for this example. And then the different fee tiers, I want to make sure I have all of that open. So to compare like the APR across all pools here, what we can do is filter by age and try to find the full range positions because that's going to be like the most accurate assessment because all of these like pools have different ranges, right? It's not fair to compare like, one range with another range in different pools. So I like to look at full range. This is pretty much full range. So over the last 389 days, the fee APR for a full range pool on this Arbitrum fee tier is roughly 8%. But if we go to something more recent to let's say the last 180 days, so over the last 6 months, the APR in this pool is roughly 11.3%. So pretty good. If we compare it to the base pool here, over the last year, it's only 6.5% in this pool. If we go to 180 days, 6.91%. If we look at something more recent here, still roughly 6 to 7%. So not too great in this pool compared to the Arbitrum one. And then I can look at the ETH mainnet pools as well. Look at the age. So this is close to a full range here, 18% APR, 17% APR. But the more recent one is roughly 9% APR. So this pool could be good on ETH mainnet if you're working with more capital. If we zoom out here, we could see the liquidity concentration. So it's not too bad. And if we want to see if the fee is consistent, we could click on this volume to TVL tab, zoom out to 180 days. And here I could see that maybe the 180 days APR might not be accurate because the volume was much higher back in 2025 compared to where it is right now in this pool. So maybe if I filter by age again, I would expect closer to like 8 to 10% APR for a full range if the volume doesn't pick back up. And I could basically do the same for each one of these pools, right? And that's how you could pick out like the best APR pools. If we go back to the Arbitrum one, and here I could see the volume is much more consistent compared to the previous mainnet pool that we just looked at. So the APR might be the best for this pair. And you guys can backtest your position as well and see the rough APR you could generate. And let's say I only deposit USDC, I could do that. Let's say I put in 10,000. I could run the backtester here. So sometimes the data doesn't work. Let's use the Ethereum mainnet as an example because the Arbitrum data is not loading right now. If we use this 0.01% fee tier here, I could set my ranges. Let's say 1,800 to 4,000 is my range. If I'm optimizing for fees here, I could choose to deposit only USDC. If I put in 10,000 USDC, I could run this backtester here. I could also deposit directly on Revert, but you do have to pay a 0.65% swap fee if you do that. And you can see with the ranges I set, I would be earning roughly $300 something over the course of the last 30 days. So let's say it's 322, multiply that by 12, divided by $10,000 that we put in, roughly a 38% APR on our capital. So pretty good APR here, especially if I'm running a wide range strategy, which I do. And we could compare like the different fee tiers that we find, right, to basically find the best APR pools. And when the Arbitrum data comes back online, you guys could test that as well. So that's how you find like the best APR pool and basically maximize return while taking the same exact risk. If you guys are yield farming the same pair, but then you're providing liquidity for really low APR pools, you might be, down here. Versus if you know how to find the best APR pools, your return might be here, taking the same exact risk, right? So that's another way to boost your return. So just a quick recap of what we just went over. The first way to earn more return is simply by taking on more risk, because most investments would fall into this spectrum. If you take on more risk, then your potential return is higher. We can take on more risk in yield farming by yield farming more lower cap altcoins that have a lot of volume. But you also need to make sure you're selecting tokens that have the chance to appreciate in value over time that you believe in and have solid fundamentals and main reasons why it would go up in price, right? And the second way is making sure that we're taking profits on our position. One way to do that is to use your fees to basically de-risk into Bitcoin, Ethereum, or stablecoins. And another way to do it is to close out your position when you're sitting in a profit. The third way to increase your income is to make sure that you're compounding some of your fees into your current position. The fourth way is to use some of your fees to basically create new positions. That's how I was able to basically start diversifying my portfolio. I started with only like 1 to 2 pairs, and then later on, I'm able to create a much more diversified portfolio. And lastly, we want to make sure that we're finding the best APR pools for our assets. And one last note here, if you guys are working with a lot of capital, but you're prioritizing security over the APR, then you might not even yield farm in this L2 pool, right? You might just stay with the mainnet pool just because it's more secure on mainnet. If you guys thought that was helpful, then be sure to check out the other videos on my channel. I mainly focus on yield farming, and hopefully these videos would help you become more consistently profitable. There's a ton of misinformation out there when it comes to DeFi, so I try my best to put out like the good information and a more unbiased take. And if you guys want to be notified when I publish new videos, then feel free to turn on the notification bell as well. Thank you for watching. I'll catch you guys next time.